Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. The Fed wrapped up its annual Jackson Hole Symposium on Saturday, but it was on Friday in that keynote address that Fed Chair Jay Powell signaled a rate cut could happen as soon as September.
With policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks.
Jay Powell there. Now, at the end of this week, we're going to get the Fed's preferred measure of inflation. The Personal Consumption Expenditures Price Index is due on Friday. Also due this week, Chinese industrial profits for the month of July. And in a moment, we'll talk with Ching Wang, Chief APAC Economist at Vanguard Group. But we begin here in the States. Joining me now is Matt Orton. He is Head of Advisory Solutions and Market Strategy at Raymond James Investment Management. Matt, thanks for making time to chat with me. I want to begin with the Powell speech. What did you think? What did you make of what Powell had to say?
So, Doug, I think the Powell speech was more dovish than a lot of folks were expecting, myself included. And it certainly, I think, changes the narrative in the market a little bit. I think rather than being focused on inflation as much, we're really going to be keenly focused on the employment data that comes. So PCE matters this week, but nowhere near as much as payrolls are going to matter on September 5th. And so given the massive rally that happened after the dovish tilt that Powell took, I think the earnings we get from some of the tech companies, Nvidia first and foremost on Wednesday of this week, are going to be really important for sustaining the rally, especially in, I'll call it, higher beta parts of the market. And then we'll see whether or not the data we get continues this very, very optimistic outlook on the case for not only just a September cut, but increasing the chances of cuts going into the end of the year.
We can talk about Nvidia in a moment, but I want to get your sense on the degree to which there may have been a bit of short covering that was a part of that rally on Friday.
Oh, there absolutely was. When you look at some of the biggest outperformers on Friday, a lot of names with higher short interest were squeezed higher. I think this whole small cap complex in particular, had one of its best days in quite a long time. And a part of that was just very extended, leveraged short futures positioning in a number of the small cap indices. And then you look at the home builders that also had a massive rally, banks, smaller cap banks. You really saw, I think, not only just a squeeze, but anything that could be supported by the prospect of lower interest rates really caught quite a bid on Friday.
So after the bell on Wednesday, we'll get the numbers from Nvidia. Clearly, this company is at the center of artificial intelligence development and the whole story around AI. And Nvidia now really is, I think, a bellwether for not only AI, but the broader market as well. When you look at the weight of Nvidia within the S&P 500 being at nearly 8%, that's a pretty powerful force. So there's a lot riding on this number. What are you going to be looking at critically for the Nvidia story? Is it more the outlook?
I don't think Nvidia is going to miss numbers. That would be quite a shock. It's how much does Nvidia beat by? And then really critically is what are the expectations going forward? Because just to break down the importance of Nvidia earnings, Nvidia alone has contributed just about 20% of the earnings growth of the S&P 500 this year. I mean, that's a staggering number. And if you just add in the entire AI complex, so call that information technology, broadly speaking, some of the other ancillary AI trades like the electric equipment companies, some of the utilities, those collectively have contributed north of 80% of the earnings growth of the S&P 500. So the degree of how much this trade continues absolutely matters. We got good data and really good CapEx numbers coming out of the hyperscalers. So the hope is that NVIDIA's guidance is going to project strength with respect to the read-through from that. And I think it's even more critical because we've seen a recent pretty aggressive rotation out of momentum technology into values and cyclicals over the past 2 weeks or so. That's really left a lot of investors in these trades feeling pretty whipsawed. So I think being being able to see strength from Nvidia is going to be critical to getting this AI trade on a sustainable path going forward, to help, I guess, lean out of that rotation and see the bellwethers and hopefully broader market forces really lead the market higher. So there is a lot of importance put on Wednesday, and then by extension Thursday, where you get Dell and Marvell, which will be almost a continuation on the semi space.
So to your point about the hyperscalers, if you look at companies like Meta, Microsoft, Alphabet, Amazon, those companies equate to about 40% of the revenue for Nvidia. Is this stock kind of the situation where we like to use the term, price to perfection?
Anyone who said Nvidia's price to perfection in the past has been wrong, just because the stock continues to go higher. But I think, Doug, your point is taken, because I don't often love to see stocks run up into the earnings report where there's so much importance put on what it is the company is going to report and guide in particular. So the bar is just set incredibly high for Nvidia. And so I think valuation wise, the earnings number could be spectacular. You could continue to see multiple contraction on a stock like Nvidia supported by strong earnings, but it's really all about the guide going forward and how much strength and read through you're going to get from those hyperscalers that you just mentioned, going into their outlook over the rest of this year and forward into 2026.
So at the end of the week, it's the Fed's preferred measure of inflation, PCE. I think the core rate is expected to be up kind of at an uncomfortable level, annually 2.9% from a year ago. Do you think that would dissuade the Fed from kind of the course that we seem to be on right now, with Powell articulating that concern about a weaker labor market may carry the day rather than a little bit of worry about inflation?
Yeah, I don't think it's going to change the outlook that much, because I think expectations have been pretty accurate going forward, and we've kind of seen all of the components that are going to feed into PCE. So I can't imagine there's going to be a big deviation one way or the other on the numbers that we get this week. And especially with Powell talking about this curious balance during his speech, where the emphasis is going to be on employment. And so I think all of that just minimizes the importance of what we're going to get with respect to the inflation numbers, and really will emphasize the importance of the NFP that we're going to get on Friday the 5th.
So we're talking a lot about the U.S. market. I'm curious, if you look offshore right now, are you finding value?
Absolutely. One of my key themes, Doug, heading into this year for clients, and especially the back half of this year, was building balance. And to me, balance is across asset classes, it's across geographies, across sectors, industries, market capitalizations. So in addition to looking more at small caps and opportunities and higher quality small caps, I've really been trying to find opportunities across international markets and emerging markets in particular. The two big names, China has had a lot of strength recently, and despite some of the economic challenges that the country faces, the strength being projected by the large internet companies and in some of the actions the government is taking with respect to semiconductors and building more within China, I think that provides a boost for the strength in China to continue. And you're seeing risk-taking increase onshore. So all of that, I think, can continue the trend that you've had. So China looks very interesting to me. And also in the EM complex, India has really been the big underperformer. You've seen a lot of weakness over the past few months. A decent chunk of that has been disappointing earnings. But after some of the changes the government is making with respect to tax reform, that should help incentivize consumption to really get the economic growth numbers, which, by the way, are probably going to be around 7% of GDP growth. I think that should turn around some of the weakness in earnings. And that, to me, also looks very interesting, not only from a relative valuation standpoint, but also just from a long-term secular investment theme of a country with 1.4 billion people and a massive growing consumer class.
So if we had to identify themes, then the sense that I'm getting, let's talk China, and then I'll let you go. Is it more tech-driven than being consumption-driven? Is that the thesis?
It is. The consumer in China has been weak. I don't know when and if that's ever going to turn. Maybe it turns if the government actually takes some of the massive fiscal action that I think is going to be necessary in a country where there's just increased savers. So a lot of the growth and a lot of the earnings to me are coming from the technology complex. And you've seen really strong earnings from the big four. In addition, you're seeing strength in some of those semiconductor names where I think the government's moving industrial policy to help support them, especially as the U.S. and China continue, while maybe not explicitly in the news, but there's certainly, a continuing, I'll say, war for AI dominance that's happening, and China's going to invest heavily there. So there's certainly room for that trade to also continue and add into the market. And those are just bigger weights within the market as well.
Okay, Matt, we'll leave it there. Thanks so much. Matt Orton there. He is head of advisory solutions and market strategy at Raymond James Investment Management, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Equity markets across the Asia Pacific are following in the footsteps of last Friday's rally on Wall Street, and Chair Jay Powell opening the door to a resumption in rate cuts maybe as soon as next month. For more, we heard from Chen Wang, chief APAC economist at the Vanguard Group. She spoke with Bloomberg TV host Sherry An and Avril Hong on the Asia trade.
So we are still unpacking some of these Powell comments. The read-through is that it was very dovish. How much cover does this provide to Asian central banks, including the Bank of Korea that has a decision due this week?
Thanks for inviting me today. Good morning. To a certain extent, I wouldn't characterize the tone of Powell to be very dovish. I think it's actually a pretty balanced tone. It does recognize that the balance of risk is shifting, so that makes a September cut to be the baseline at this moment. We have been expecting 2 cuts this year, September and December. That seems to be still appropriate after Powell's comments on Friday. However, I think when you listen to his speech and comments, he continued to emphasize the risk on inflation. So to that extent, even if we get a cut in September, I would more characterize as a more hawkish cut. And I think the decision of Fed will be very much dependent on data, especially how weak the labor market will be when they actually make that decision in September. In terms of Asia central banks, now, of course, everybody is watching Fed, what they will do. But I think ultimately, for Asia central banks, their decision will still very much depend on the domestic situation, as well as their reaction function, right? Especially the weaker dollar so far this year is providing central banks some, flexibility, right, to make their decision. You mentioned about Bank of Korea. I would say they probably want to stay on hold this week to be in rather a wait-and-see mode, right? On one hand, we always know that Bank of Korea cares a lot about financial stability risk, housing prices, household debt, and at the same time, we do know Korean growth outlook actually has improved slightly recently. So I think they would just want to, wait a little bit and then, probably wait until October to see what the Fed will do.
But on that Fed rate decision coming on September, what are you seeing in terms of the economic data that has Chair Powell leaning towards a cut? Because we continue to see inflationary pressures high in the United States and, of course, more fiscal policy perhaps opening the taps for a more overheated economy there.
Yeah, totally. I think at this moment, what is clear in Powell's comments is that Fed is willing to look through the tariff-related inflation as long as inflation expectation is well anchored in the long term, right? So given that, I think in terms of the reaction function, you clearly see the focus is shifting towards the labor market strengths. So I think the question here is that how weak the labor market is, especially I would say whether the weakening in the labor demand versus the decline in labor supply. So I think the critical data to watch, obviously inflation will be the one, but unless there are significant jump in inflation data, then I think the key is see, what is a non-farm payroll, number, and also where the unemployment rate goes. I think that will be something to be critically watched by Fed. Now, that said, I would say, even though Powell said that there should be adjustment in terms of monetary policy, I would say that adjustment will be very gradual and also to a certain extent be rather limited. One is, as you were saying, that the inflation risk is definitely on the upside. Especially when the economy seems to be running, pretty hard with the fiscal policy stimulus that's coming. And the other one is also the neutral rate in the economy is higher. So even though we do expect Fed to continue to cut into 2026, we see them stop at 3.5%, by end of next year.
What about what else we heard from Jackson Hole, including from BOJ Governor Kazuo Ueda, talking about how the tight labor market exerts upward pressure on wages? Is that a hawkish enough read-through to you that maybe coalesces expectations around an October rate hike?
Yes, I think BOJ is really the outlier among global central banks. So I think, Japan's situation is a bit different from, other countries. At this moment, we see that Japan growth at this moment is really sustained by domestic demand. We do see some structural turnaround in domestic, both consumption and investment. And also we do see that there is a structural change in the price setting and wage setting behavior sustained by the very tight labor market, right? So given that, I would say, we do see a good chance that inflation will continue to pass through from wage to price. And then core inflation should be able to sustain, around 2%. And that actually provide enough support for BOJ to hike, interest rate later this year, especially when the trade external uncertainty actually has reduced quite a bit after the trade agreement has been achieved. So this is where we actually see BOJ to hike once this year and then continue to do so and gradually bring the interest rate to neutral in coming years.
Deflationary pressures, on the other hand, affecting the Chinese economy as we continue to get data that doesn't look too positive. Will we see the PBOC moving at any point? Does more easy money make sense for this economy at this point?
Well, I think when you look at China, China is totally the opposite story. The weakness is really on the domestic side, right? I mean, export has been holding up so well, so far this year. But, we do see actually more signs of a domestic slowdown. And also this kind of significant demand supply imbalance is really driving this deflationary pressure. That's, I think, exactly why the government is actually trying to address this more structural issue with the anti-involution, campaign. But I would say, to deal with this deflation challenge, the key is really on, boosting up the demand. On the other hand, I think the anti-involution campaign is likely to be rather gradual and sector specific. So the impact on, addressing the deflation challenge is likely to be limited. Now, in terms of central bank, I would say, yes, I do think there's room to cut interest rate, when the economy is stuck into this kind of persistent deflationary pressure. But we always know that central bank in China is always reluctant to cut interest rate. So we expect only a very modest 10 base point cut later this year. But even that, I would say, is probably only later this year when the policymakers see more concrete evidence of a downturn in the economy. That is when they're going to step up with more policy stimulus, both monetary and fiscal.
All right, Chang Wang, good to have you with us, Chief Asia Pacific Economist at Vanguard Group.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.